This iron ore report has sent panic through Australia, and if it's legit, our economy could be in trouble. So real quick, iron ore is the raw material used to make steel for modern infrastructure, so buildings, bridges, trains, and so on. Australia is one of the world's biggest iron ore exporters thanks to all our mines. This also makes iron ore one of our biggest income sources. Now, China has been our main buyer of iron ore for many years, which has been great, but also means the Australian economy has been heavily tied to Chinese demand. And therein lies the problem. China's economy has been struggling. Its property market is weak, construction is slowing, and steel demand is dropping. This has always been sort of a looming threat at the back of our minds, but this Bloomberg report just took things up a notch. The report claimed the Chinese government had ordered its steel companies to temporarily stop buying new cargoes from BHP, which is Australia's largest mining company. Now, we don't know how long temporary means. We don't know if that means temporary on the way to being permanent. We also don't know how legitimate this is. Analysts say there's a chance China is bluffing in the hopes that Australia will bring down its prices. But either way, it's a worry. See, with iron ore prices falling, BHP had already recorded its lowest profit in 5 years. And the bigger issue here is what this move represents. China no longer relies on us the way it used to. There are two key reasons to this. First, China is recycling more of its own steel, which is cheaper, greener, and in line with global trends. We're already seeing this in Europe and the US. The second reason is right here, at the Simandou mine in the southern highlands of Guinea. This is Africa's largest mine, and it's expected to start exporting within months. It's estimated Simandou holds over 2 billion tons of high-grade ore, which could be of even higher quality than ours. If this mine enters the race at full scale, China gets a new supplier and stronger bargaining power. And even if they still buy Australia's product, the new market would give them negotiating room to push our prices down even further. Now, let's forget the prospect of a full-scale ban for the moment. China, even just scaling back buying Australia's iron ore, would affect us. It would mean less money coming into Australia. It would mean less tax revenue and fewer royalties for states like Western Australia, which means less money for Australian hospitals, schools, roads, infrastructure projects, and so on. It would directly affect not just people who work in mining, but also local businesses in those towns that need people working there to stay afloat. On a wider scale, the Australian dollar could fall, which would make imports more expensive. And it adds more urgency to Australia to diversify its economy, which is something analysts have been telling us to do for years. Now, before you panic, a couple of things. The Simandou mine has been delayed for decades due to cost, corruption, political stuff. Even if it launches, experts say it could take years to ramp up to full production. Also, the Bloomberg story has been disputed by a Chinese firm called MySteel, which said Chinese steel mills have received no such notice. So, is this a short-term bargaining tactic, the start of a bigger shift, or a whole bunch of hot air? Either way, it's a reminder that Australia's iron ore success is also fragile. The world is changing, China is changing, and the pressure is now on us to change too.